All right, so let's talk about market trends. This is one of my favorite things, and I want to talk a little bit about really just what's happening, right? So this is some historical perspective you can see all the way back into the 60s of new home sales, kind of with those recessionary lines kind of put over top of
Yeah,
them.
those blue lines are the
Mhm.
recessions.
So you can kind of see what's happening. Clearly, our home sales, even in the 70s, 80s, 90s, are very similar to what we're experiencing right now with a much larger
But
population.
it's remarkable too, because if you go back to the '60s, right,
Mhm.
what population was half of what we're at right
Maybe
now,
less, yeah.
maybe less. And so to see new home sales still bumping around like 1972 levels, wow, like that's showing again, our thesis has always been we've underbuilt for a good decade or so here in the United States, and it's only causing home prices to continue to rise, even when we have a recession in the real estate business.
Absolutely.
So it's clearly we need more homes built.
So this is housing starts, single, and the blue line being those 2+ units. So anything multifamily of any kind. But you can see that void is getting big, right?
Yeah.
I mean,
The separation between the two is big, and I think what this speaks to is that 2+ unit starts. A lot of it is commercial properties, which are more than just 2 or 3 or 4 units. It could be an entire building, right? And they have somewhat overbuilt that, and they have definitely some serious debt. Some of these large commercial holders are having to deal with. So that's why I think you're continuing to see there's a big gap between residential single family type structures and then those multi-unit ones.
we talk about existing home sales. This is where we are as sort of our bedrock levels, but there's also a couple of years of projection sitting on here, which is kind of fun to see. And you can really see as kind of we move towards this.
And
Where will
I
we
think
be,
if
right?
you look at just the 2013 to 2019 time period, a normal-ish kind of time before COVID, right? We were always above that 5 billion level. We're a whole million off of that level right now. So once we start to see interest rates go closer to 5%, I think we're going to start to see a rapid escalation again, because it's a rubber band that's stretched.
Exactly. But here's the other thing is if interest rates don't change, how much can this actually change, right? Because buyer behavior has to have something to influence change, right?
Mm-hmm.
People don't just start buying homes on a whim, right? Like there truly has to be something that affects their affordability. And so unless housing affordability changes, we could be stuck in this sort of vein for a little bit longer period of time. All right. So what about this one, Jim? Explain
Well,
what's
I
happening
wanted
here.
to just show you too what active inventory per year looks like. So think of all the darker lines as basically the normal years that are above us. Here we had started out 2020 with higher levels of inventory than we did now, but obviously things shifted quite rapidly. As the COVID thing hit. But in the past years, the non-unicorn years, we had more inventory. So where do we expect inventory to go long term? More normalizing back to that level. What's holding it back? The fact that so many people are sitting on low interest rate homes and they don't want to move.
Absolutely. So
Yeah, and this one is interesting too. So this is if you take all the homes that are in the United States and you look at what percentage of homeowner equity sits in those homes, well, right now we're at about 70% of the value of the average home is owned outright by the homeowner. And you could be sitting on a home where you just put 20% down. You're like, how the hell is that accurate? Keep in mind, 41% of all homes are outright owned by people with no banks involved. So that
Well, and
shifts
also,
that up quite a bit.
you buy some of these homes back in 2012 to 19, right, pre-pandemic, and all you did was refinance them during the pandemic. You truly could be sitting on 50, 60, 70% equity.
Yeah.
And many of these homes are actually in that position now. So there's a lot of real estate equity in the US. Now, this is really real estate values and household mortgage debt as a percentage of GDP. So you can see that there's so much wealth in the household that basically it's way more than the size of the US economy. And it actually has been growing over basically the course of recorded history, which is a good sign to see. The only time we had more equity in our homes than this was when we were in that big bubble back that caused '08, right?
Yeah.
So the good news is we're not in a position like that again, because you can see the mortgage debt didn't balloon with it, right? Mortgage debt, yes, maybe it's a little bit higher than it was back in the 90s, but it really has been steadily declining as wealth has been growing.
Yeah. I mean, the mortgage debt as percent of GDP, a little bit worrisome. It has doubled, over the last 50 years or so. But yeah, the amount of equity people are sitting on, though, because of it is more than compensating for it.
Absolutely. All right, what about this one, Jim?
Well, we talked a little bit before about how this market is very regional, right? There's winners, there's losers regionally, and here you can clearly see, breaking into more of a deeper dive where those regions sit. Everything in the Northeast is really doing well, and they're seeing prices increase. But from a buyer perspective, you don't have a lot of choices. Your home prices are rapidly growing up. You have probably one out of three going over asking price in that marketplace, if not more. And then you look over towards the central part of the United States, the Southeast, and the West, and clearly it's a lot more of a muted market that we're seeing here. Some cases even price declines, and the price growth for last year wasn't all that great either.
No, it wasn't. All right, so let's look at this one. This is a little bit about employment, right? So as we look at employment here, you can see some of just the meager employment growth that's taking place across the nation right now. And this is really part of that response as to like what takes on the whole picture, right? Because a job is a house in so many ways.
Yeah. Low hire, low fire environment clearly reflected in essentially an anemic job market here. Decent amount of, job losses, but it's been a rather steady amount. The readjustments that they've done over the last year show that we've lost a lot more jobs than we expected. And there's a lot less job growth than expected. So that constantly changes, but it doesn't bode well for, say, a rush of people to go out and start buying homes.
So do you expect your home or the homes in your area to increase in value in 2026? This is a poll taken by Kin. And essentially, some people think that there is going to be significant or moderate increase in growth. I would assume that that's probably a large population in the Northeast or around, the Great Lakes regions where we're seeing that shortage of inventory. But not very many think that they're going to see some decline or even the same.
I think this speaks to the wisdom of the crowds not necessarily being all that great too, because it's very unlikely to see a significant increase in home prices. Even in the Northeast, I think the best region was like 7 or 8%. It's good, but it's not like crazy.
It's not what I would consider significant.
Yeah. So, the projection overall, again, like a 1.6% increase in prices this year, according to all the, top prognosticators. So it's probably in that middle boat, more than anything else.
And would your mortgage interest stop you from buying, or would you consider buying if it got to a certain point, right? And so the interesting part is we're sitting above 6% today. 3% of people would consider buying with it at 6% today. And
those other 13% that says interest rates won't influence my decision, they're probably cash buyers. That's either that or they are wildly ambivalent about their life.
So I think the big thing here is, we could see another 10% of people come into the marketplace if we can get to that 5 to 6% mark. Mm-hmm. So do we need to get there? Yes. How are we going to get there? I think that's to be determined still. I think there's a couple of opportunistic people that are trying to get us there. And obviously some of the markets think that might happen where some might think it gets getting worse. But there is buyers to be unpackaged at lower interest rates. And we can clearly see that. Now, those 3%, 4%, all the way up to 5% buyers, there's just no way to unlock them until a major life change. So don't expect some huge resurgence of buyers, but will there be some? Absolutely. This is showing us that.
Yeah.